Dave made the point earlier quite rightly that we had a higher rate of potential growth if you go back sort of pre-financial crisis. Actually, so did most countries actually. So the UK is not unusual in this respect, by the way. And we've had a lower rate of potential growth, for the last 15 years or a bit more than 15 years now. And as I said in the speech, predominantly that is about productivity. It's not actually a story about labour supply so much. It's a story about productivity. And as Dave rightly said, you can link that story on productivity to investment in the economy. So addressing those questions now, I speculated in the speech about what are the determinants of that. I think there's more than one. I think the question about ensuring, for instance, investment in the real economy, so the pension fund question is important. But there's a much longer term and international question about waves. I made the point about what we tend to call general purpose technology innovation. There are waves of innovation which do raise productivity and investment in the economy. And I addressed the question, is AI the next wave? Well, maybe it is. I do take the view that we've got to be set up all round to take advantage of that, because that is, if you look at history, that is the thing that will actually raise productivity growth.
Just on that. I couldn't agree more on the importance of productivity and its role in the sort of short, medium, and long term in terms of activity. And we've talked before about the importance of appreciating that activity is driven by both demand and supply, and you shouldn't just see it from a demand lens. The other thing I would say is in the near term as well, there are other reasons that we expect growth to strengthen. We do expect real wages to rise in the coming period. That will lead to stronger consumer demand. We have, as Dave says, a very high savings ratio at the moment. That could come down. Obviously, in reducing interest rates, we're reducing the amount of monetary restriction in the economy. So there's also reasons to expect the near-term picture to improve as well.
And although we're dealing with unpredictability in trade policy and one has to kind of keep perspective, because the reason we've been talking about uncertainty so much over the years is because the world economy has had to deal with a lot of different shocks. So, we did see in early April that the VIX, for example, in terms of equity market implied volatility, that rose to its highest level since 2020. But that's since 2020. It wasn't off the scale. And actually, in the last couple of weeks, and again, Andrew was touching wood, markets have been calmer, although they still remain quite volatile. And that's more just a kind of feature of markets, because partly they're responding to fundamentals, and then you expect market pricing to change then. And then there will be things, the adjustments that have to be made. Andrew emphasised how our system-wide exploratory scenario pointed out the adjustments that may have to be made. So in early April, we did see some deleveraging. But when that deleveraging happened, people were selling, but there were also people buying. So markets found, settled in a new place. And, we tracked that volatility very carefully, as did other jurisdictions. But the overall system has been resilient, as Andrew emphasised, which is crucially important in terms of financial stability.
Let's go to Maureen and then David.
From the Times. 2 questions, if I may. Given that the UK is more exposed to the indirect impact of tariffs, is it fair to say that whatever trade deal is signed today, the sort of game changer in this relationship is actually between the US and China? And it's only if we get a major de-escalation on that front, given that China is subject to 145% tariffs and they go both ways, that is going to be the key relationship which will maybe lead to a material change in your outlook on what tariffs mean for the UK, rather than what's going to happen this afternoon. And just on the inflation persistence, beyond the creep up in inflation expectations, what other evidence do you have that this temporary spike could lead to more second round effects beyond what you're seeing in survey data? Do we know anything else beyond what we knew in March or February about the risks of more persistence through the second round?
I'll start off on China. I think you're right, Marine. China is is obviously a very important part of the trade story, and obviously the tariff action taken on both sides in the China case is much more substantial. So I think whatever, in a sense, transpires between the US and China will be an important part of this story. I'd also go back to just to emphasise a point I made earlier. Actually, I think it's very important, therefore, as to where US and China get to in whatever discussions they're going to have. I think it's also important then to come back to this point about what I might call the more fundamental point about the way the world trade system works and the way the multilateral system works and the way the World Trade Organization works. Because although I would take issue with the idea that every trade balance must be in balance, because that's not the way trade works. It is important to have a much clearer sense of what are the long run, if you like, unsustainable imbalances in the system, and what we should do about them, and how the multilateral system can assist in that respect. I've said it once or twice. I do think that there is an imbalance there. I think China's household domestic demand is weak, and that's accepting the fact that China is has developed, and of course that's to be expected. It has had weak household domestic demand over a long period of time, but obviously in the way the trading system works, there's the other side of that coin is somewhere else. So I think we know that the other side of that story. So I think the question about how the international system, which we're all involved in, can assist in identifying those more persistent issues, as opposed to the sort of the issues that aren't issues because they're just the transient nature of the way trade balances work, is critical.
Let me talk a bit about inflation expectations and the risks about that. I mean, as you'd anticipate, we spend a lot of time looking at, monitoring, thinking about inflation expectations for households, as well as for firms and in financial markets. And you're right, they've household expectations in particular have ticked up, and so we're thinking a lot about that and why, and we do a lot of analysis as to what might be driving that and those sorts of things. I mean, I would reiterate, in our expectation is that the increase in inflation we're going to see later on this year will not be persistent, and it will come back down, and it won't lead to second round effects through people's expectations. That said, we do and have done a lot of analysis of things like, what is the relationship between expectations and people's perceptions of inflation? How do people respond to inflation for different goods and services? And what are the things that sort of drive people's awareness of inflation? And we've published quite some good analysis in that space that shows basically some items are much more salient than others and affect people's views of inflation more than others. We've done lots of work looking at, are there particular sort of trigger points for inflation at which people notice some levels more than others, those sorts of things. I mean, I would say we're expecting this increase in inflation later on this year, for particular driven in large part by some of the items that Andrew's talked about. We're not at all complacent about that, and we also recognise that will be incredibly painful for people, particularly where this is around energy, food, really difficult. It isn't, however, anything like the sorts of numbers that we did see a few years ago. We're talking about peaks, our estimated peak is around 3.7% later this year. Obviously, that's far less than it was, but of course, difficult for people, and of course, different people have very different experiences of that. No, we're not seeing evidence of that, and actually in some of the areas where we have seen changes in inflation. If you take, for example, where at the moment we're seeing slightly higher levels of food inflation than say pre-COVID. Actually, our agents tell us that we might have reason to expect more competition coming for some of those items. So it obviously varies by product, by sector, and we're monitoring it carefully. Our agents are out there talking to and gathering that intelligence, so we've got it as much as we can, as fast as we can and as comprehensively as we can, which we put alongside this sort of research that we do on some of these other factors. So we're not sort of seeing evidence of it, and actually in some areas quite the contrary, particularly as I say on, for example, food, which we know is incredibly important to people and drives a big part of people's experience of inflation as they see it.
I think we have time for two more really quick ones, David, and then Anna.
Thank you, David Milliken from Reuters. First question, really how concerned are you that we're likely to see larger multinational companies decide to put up prices in the UK as part of essentially a global pattern of price rises? And secondly, just a more technical thing, given some of the volatility that we've seen in bond markets and particularly 30-year gilts, whether that's causing the Bank of England to think that when it comes to planning QT for the next 12-month period, starting in September, whether you might rethink how you approach this and the balance of gilts that you sell.
Well, I'll take the first one. Dave will do QT. I think it's an interesting question about global multinational companies, David. You ask a very interesting question, and one that we've got to, I think, keep a very careful eye on, because we've distinguished in our analysis the way in which tariffs will have a different pricing effect between countries on either end of them, as it were. Whether you're in the country that's in a sense setting tariffs or the country that's on the other end receiving them. Now, your question in a sense quite rightly says, well, hang on a minute. Is there something else that cuts across that, which is global companies that don't make that distinction and just say, we're going to impose a pricing solution which goes right across the world, irrespective of those differences. Now, I think we have to watch. I think we do have to watch that carefully. I think it's too early, really, to reach a conclusion on evidence. I don't think we've seen a lot of evidence yet. One or two bits maybe, but we haven't seen a lot of evidence yet. But I think you're right to pose the question, because it would cut across that rather conventional trade approach model, which would say, no, there's a difference between these two things.
Yeah, just on QT, I think it's important to emphasise that through this period, the MPC hasn't changed the size or pace of the QT envelope and the way that the bank is then delivering it for the MPC. So we've got that 100 billion reduction that, as you were saying, takes us up from last October to this September, and with the process will get going soon. It's an established process now for the MPC to consider what it wants to do for the next year, and I'm certainly not going to anticipate that here. I think it is then worth, just within that context, making very clear that it was the bank's executive. We made a decision back earlier in April to switch the ordering of our QT operations in the context of the market volatility. So we swapped out the one long auction we had and went ahead with an additional short auction instead. That made sense given market conditions, but that was very separate. The MPC, as we flag in the minutes, was informed of that, but that was a bank executive decision.
Great. Anna.
Thanks. Yeah, Anna Wise from Press Association. Thanks for taking my question. Mortgage rates have been slow to come down, but at the same time, savings rates are dropping at a much faster rate. Are you conscious of this, really? And do you think people have confidence that your decisions are feeding through to the market?
Well, that's a good question. Mortgage rates nowadays are priced, because the large majority of mortgages are now fixed rate mortgages over typically 5 or 7 years, some are 2 years, but 5 or 7 years. They're priced off the swap curve. So they're priced at rates which are set in the market. Obviously, they bear a relationship to our decisions on the bank rate, which is how obviously monetary policy transmission works. But of course, markets anticipate what we're going to do. So those rates have already moved around in anticipation of the announcement we made today, for instance. I think broadly the movement of mortgage rates and the swap curve broadly reflects the movements in rates. So I'm not particularly surprised. I think there's been, as we've been saying throughout this this conference, there has been, of course, more market volatility. Some of that has come through into rates. There's a question about how much term premium effects are coming through, which would change that relationship. But still, broadly, there's a relationship. Now, on deposit rates, as I said before, I would draw the distinction between what I call sight deposits, payable on demand, and term deposits. Term deposit rates have moved much more in line with what term deposits over a period of time, that is, have moved much more in line with our rate decisions. Sight deposits have not moved as much as in line. And I've said at the Treasury Select Committee once or twice when asked this question, I'm not surprised by that, because one of the things that has really changed in the last decade is that post-financial crisis, we now have a bank liquidity framework. In other words, a framework for banks maintaining their liquidity buffers. The consequence of that is that the value of term deposits is a lot more to the banks than sight deposits, because they obviously don't run as fast. That's the simple fact. So I'm not surprised that term deposits are more responsive to pricing, those sorts of pricing signals than sight deposits.
Great. That's all we have time for. Thanks, everyone.
Thank you very much.
That was the Bank of England press conference, of course. Officials there speaking following the central bank's rate decision. Let's just recap some of the lines we heard from that press conference. We've already talked about the decision itself, the slightly hawkish nature of the language, maintaining some of the language that was seen as fairly hawkish, and the vote split perhaps seen as a little bit hawkish as well. But in terms of what we heard there from the press conference, interesting to note from the Bank of England governor himself that he said he was fairly undecided going into these conversations about which way he was going to vote. And there was quite a lot of mention, as you would expect, in the questions on trade. And the governor took some time to reflect on that in his opening remarks, and then gave his thoughts on trade as we went through. But we heard from him that he welcomes the possibility of a trade deal between the UK and the US, and in fact wants more trade deals to take place, sees that as a key source of uncertainty in the global market, wants to see a China-US deal, or at least went so far as to say that's an important part of reducing that uncertainty, and noting that Chinese domestic demand is still weak. So quick check on some of the assets we've been watching. We've seen a drift higher in the pound during that, up by 0.3%, so 133.35. We'd seen the pound stronger before the press conference. It continues to be so. In terms of the yield story, then we've also seen those yields drifting higher. They went higher on the back of that announcement from the Bank of England about the vote split and the language, and they've pretty much stayed there, so up by 7 basis points at the 2-year horizon. Bloomberg's Lizzy Burden is at the Bank of England for us. Lizzy, your takeaways from that?
Well, effectively, Anna, the governor just confirmed that this was a Trump cut. Even though he said that the fundamental starting point was the UK economy, they said that the upward pressure on inflation is going to be temporary. In other words, it wouldn't be there were it not for the tariffs. And the minutes showed that were it not for Trump, the MPC would have voted to hold rates, or it would have been pretty close to that. So there wouldn't have been any need domestically to cut rates were it not for the tariff war. In terms of the path ahead for rates, as we try to make sense of that three-way vote split, they said that more uncertainty ahead doesn't necessarily mean more rate cuts, because you could see lower growth, but you could also see higher inflation. It depends what happens to supply chains. But if you look at the forecasts, they endorse the market curve for 3 more cuts by December. So for now, it doesn't look like we're going to get that June cut that some were wondering about before, and indeed at one point markets were pricing. They're going to continue to proceed gradually and carefully. And just finally, on that US-UK trade announcement that we're expecting in just under 2 hours' time, as you say, Bailey welcoming anything that gets us closer to free trade, says it helps lower uncertainty, and says that there need to be more trade deals, which to me speaks to how insignificant a US-UK trade agreement is compared to, for example, a US-China trade deal, and how much that would affect the rest of the world. But in the meantime, we're just going to have to await more details on what the US and the UK have agreed when we get that press conference at 3 p.m. London time from Donald Trump.
Yes, it's the wider mood around trade that matters, as well as the details of the UK-US deal then. Lizzy, thank you very much. Bloomberg's Lizzy Burden with details. An interesting question, of course, is how far this trade conversation goes, how far this trade deal, if that's even the right word, economic agreement between the two countries goes. Maybe we'll get into that in a moment. But let's go to John Stepek, author of Bloomberg's Money Distilled newsletter, and with us, Jamie Rush, back with us around the table, Chief European Economist at Bloomberg.
The uncertainty takeaway is the main one. And to be honest, I thought it was quite if you like, I think the Bank of England sounded weirdly more confident than it has in a while. I would say that's partly because the news has actually been going its way in recent weeks. I mean, I think one of the most significant things is the drop in oil prices and in the energy price generally. That kind of bodes well for inflation in the UK over the coming kind of year or so. And that means it will come in a bit lower than the bank was expecting. That gives the bank a bit of leeway to take this gradual but lowering process. I think that's actually really important because there was no guarantee that, I mean, the oil price kind of falling as sharply as it has in the past month has been kind of a surprise, and it really is a bonus for us from that point of view. And again, I think it just kind of, the idea that we're getting a trade deal as well with the US now, I mean, obviously it's minor in the grand scheme of things, but it is kind of good that we've ended up being first on the list there. I think it's easy to be a little bit too negative about that because, you know, we don't want to get our hopes up, but any deal is better than no deal. So overall, I think that the sort of uncertainty, but with a hint of maybe we'll get lucky.
Yeah, I suppose there's two things with the trade deal. There's what it means for the countries involved and what it tells us about the wider picture. And I think those who are a bit negative are saying, well, does it tell us anything about the wider picture when these are two countries that don't even have a big trade deficit, that have been talking for 5 years? Does it tell us about how quickly we get a China deal, I suppose, is where the scepticism comes in. Jamie, we heard a little bit about the view on trade there. I thought it was maybe quite forthcoming on the trade subject in the way that you'd expect maybe any economist to be, but saying welcoming the possibility of a trade deal and wanting to see more of those.
Yeah, well, I think that is one of the key points, right? So when you look at the kind of the value embodied in UK exports to the US, well, a bit over half of that goes direct to the US. The other half goes via other countries. So it's absolutely essential, really, that these other countries get a deal, because if they don't, then you're not in that much of a better situation. So he's right about that. He's also right, of course, that you need uncertainty globally to recede. It's not enough for just uncertainty for our exporters to go down. It needs to be a global reduction in uncertainty if that starts translating to stronger growth. So I think he's right on those points.
OK, let me just play a little clip of what we heard from Andrew Bailey around the subject of trade.
So the UK is also affected by the way in which trade policy and tariffs affect, obviously, other economies. That is, in other words, the tariff measures that have been taken in respect of other economies. So I say that because I hope the UK agreement, if it is indeed announced this afternoon, will be the first of many. This will be good news all round, including for the UK economy. But it is excellent if it is indeed the case this afternoon that the UK is leading the way, and I do congratulate both those in the UK who are involved and those in the US too.
Jamie, as we've been listening to that press conference from the Bank of England, we've been getting all kinds of lines dropping on the Bloomberg terminal about who's reporting what, around what the trade deal might or might not contain. As you might expect, there's a lot of that sort of thing flying around. So you have other media in the United States suggesting that this trade pact could leave in place, will leave in place, is the words we're getting from other TV in the United States, 10%, leave in place that 10% US tariff. And then we're also hearing from other media here in the UK that officials are saying that a US deal is initially focused on cars and steel. I mean, if we just get something on cars and steel, that just takes us back to where we were a few months ago. That wouldn't fit many people's definition of any kind of trade deal, would it?
Yeah, but I don't think we should downplay it. So if we just break it down, so the increase in the effective tariff rate on UK exports to the US is about 10 percentage points, if you take all the carve-outs and all the other stuff into account. Of that, about 6 is the reciprocal tariff, 6 percentage points. 4 is cars. So it's actually, you know, if you get rid of the car tariffs on the UK, that's actually quite a big reduction in the overall burden. And it's also a very concentrated burden. If it's across all products, then, OK, one will just kind of find a way, they'll muddle through, they'll export to different places. If it's just on car companies based in the Midlands, that's actually quite a difficult thing to kind of organise your way around. So I think actually that was the pinch point. It's the hard bit to deal with. And if they can get rid of it, that will actually be a pretty good thing.
OK, but is it not in danger of then meaning a lot to a very few businesses, but not much for the overall UK economy?
Yeah, I think that characterisation is right, but you don't want some people suffering loads more than others. I mean, that's not the objective of what we're trying to achieve here. So I think that'd be welcome.
Yeah. John, your thoughts on it's all guesswork at the moment, isn't it, I suppose, about what exactly is in there, and our everyone's reporters out there trying to wrestle the facts from people. But if we do see 10% maintained, and if we see it focused on steel and cars, how will you digest that?
Well, honestly, see, for me, it's partly about the PR exercise here. I mean, one thing that is... So we're at a global tipping point here. US exceptionalism is in question. So, and lots of capital has been flowing to the US for over a decade now, and the rest of the world has, been starved, if you like, of investment. So people are looking at the US now and saying, right, well, actually, I'm a bit worried about the US. Where else should I be putting my money? And the UK, by contrast, has been massively neglected. We've seen relentless outflows from UK equity funds. A tiny sort of like relaxation in that happened last month, but there was still outflows rather than inflows. And the thing that I sort of feel about this deal is the US doing a deal with us and doing the deal with us first kind of gets us upward in investors' minds. Exactly. Yeah. It's the idea that the UK might be investable again. As opposed to what policy catastrophe is going to happen in the UK this year. I think that, there are concrete benefits potentially, but even if it's just, well, actually, this is a bit of a damp squib, I think it's still better than
maybe the M word premium, maybe that went quite a long time ago, but we don't need to return to that, perhaps, would be a relief. OK, so we're still trying to work out what happens with this underlying trade deal, and some of the facts obviously remain pretty opaque. Where are you looking to see where the inflation story goes next then, John, in the UK? Because Damien and I had a conversation earlier about, you do look at where global shipping is going. Is it coming out of China and going to the rest of the world instead? Maersk was saying to us earlier on they don't see any signs of that yet, but that's got to be something we're alert for.
I mean, to my mind, I do think that the inflation picture has improved. I think, though, that is mainly down to energy prices. And I think the one Andrew Bailey was saying earlier, that about half of UK inflation issue is energy. And so if we can knock that out and not worry about it as much, then we've got more leeway for whatever happens next to happen. I thought it was also interesting that one of the questions was about kind of indexing and the effect that has on UK prices, mobile phone bills, etc. Yes. And the thing is, Bailey made a really good point, which I think does get missed, which is that these are all actually extremely competitive markets. So if the providers start to take the mickey, then swapping becomes an issue again. I mean, I don't know about anyone else at the table.
You have to notice, though, first, don't you?
Well,
and then you have to take action.
But this is where my personal finance head comes in.
Yeah, you're much more active than the average.
This is it, but you have to kind of, shop around, because one thing I found was that in the last couple of years, for example, when it comes to switching my insurance policies, there's been no gain. There's been no point. But this year I've found that actually things like car insurance, home insurance, it's been worthwhile shopping around.
Okay.
Things like broadband deals, daft things like that.
Yeah.
So there's only so much of this index-linked kind of like price rises you can get away with.
I like that. Nice place to leave our conversation. John Stepek, thank you very much. Jamie Rush from Bloomberg Economics, thanks to both of you. A reminder that Francine Lacroix will be catching up with the Bank of England Governor Andrew Bailey a little bit later on today. We'll bring you that conversation from 4 p.m. UK time. That is it for coverage of the Bank of England's rate decision on TV, radio, and of course online. There'll be no doubt plenty of news headlines around trade still to come. This is Bloomberg.